Welcome to Enterslice. Today we are going to talk about GST and its benefits. Introduction of Goods and Service Tax (GST) is a revolutionary step taken by Indian government to create a simplified and integrated system of indirect taxation in India. It is set to be launched from 1st of July 2017, from when it will replace all the existing myriad of indirect taxes levied by central and state governments like excise duty, VAT, central sales tax, Octroi and entry tax, entertainment tax, purchase tax etc. It will bring all these taxes under the same fold and make the compliances easier. One of the major benefits of GST is to mitigate the cascading effect of taxes, i.e. the problem of charging tax on tax. GST is a comprehensive, multi-stage, destination-based consumption tax on value addition. Major change here is that GST is a destination-based tax, i.e. taxing authority having jurisdiction in the final place of consumption collects the tax on such goods and services. Let us try to understand all its features a little more. When we say that it is a multi-stage tax, then it means that it is levied on every stage in supply chain. For example, in production cycle of an item various stages are included like raw material procurement, manufacturing, warehousing, distribution and final consumption. GST will be levied on each of these stages separately. It is a tax on value addition, however in real time it is very difficult for the government to keep track of every such value addition. Therefore the concept of input tax credit, ITC, is introduced, which allows the supplier to claim ITC on taxes already paid on input, hence eliminating the cascading effect. The most important feature of GST is that it is a destination-based consumption tax. It is a major reform and big shift from the existing tax regime where tax is charged at the place of origin. After the implementation of GST, the taxing authority of the final place of consumption will collect the taxes. For example, if A is the producer state from where the goods are supplied to state B where they are finally consumed. In current scenario, taxes are collected and enjoyed in the state of origin, i.e. state A. However, in the new tax regime, though the taxes will be collected by state A, the final enjoyment of tax will be done by state B, which is the consumer state. As GST is a destination-based tax, in case of exports, place of final consumption is in foreign land which is outside the taxing authority of Indian governments. Thus as a result, exports are zero rated. However, input tax credit can be claimed against it. We can say that GST is a dual system where taxes will be imposed at both federal and state levels. Broadly, GST can be categorized into two types. Intrastate level taxes, i.e. taxes imposed when goods supplied or services are provided within one state. In this level, two types of GST are levied: CGST, Central Goods and Service Tax, and SGST, State Goods and Service Tax. Both of these taxes are concurrent tax charged on the same base. Interstate level taxes, i.e. taxes imposed when goods supplied or services are provided from one state to another. Such tax is called IGST, Integrated Goods and Service Tax. Let us first try to understand the meaning of cascading effect. By general definition, cascading tax is a turnover tax that is applied at every stage in the supply chain, without any deduction for the tax paid at earlier stages. This creates the tax on tax problem. In the current taxing system, various central and state level taxes are charged like VAT, GST, excise etc. But there are a lot of restrictions imposed which create the cascading effect. Few of such restrictions are: central and state level taxes cannot be claimed against each other. VAT can only be claimed against VAT. GST cannot be claimed as input credit against anything. Implementation of GST will provide a comprehensive input tax credit mechanism, which will mitigate these existing ill effects of the existing complex tax system. Under the new regime, it will become very easy to claim ITC against the tax paid on supplies. Here is how set-off works under the new regime. IGST can be set off against IGST, CGST and SGST on inputs. CGST can be set off against IGST and CGST on inputs. SGST can be set off against IGST and SGST on inputs. For more information, visit www.enterslice.com or write an email to info@enterslice.com. You can also call our experts.